Welcome to the Freedom Capital Management Strategies Quarterly Market Review and Outlook. I'm Brian Zabor, Investment Director. I'm here with Pete Murphy, Chief Investment Officer. Pete, financial markets were really strong in 2025. Could you give us a recap of how the U.S. markets performed?
Absolutely. Thank you, Brian, and thank you all for joining us. As Brian said, it was another great year for U.S. stock market investors. And one of the big storylines of 2025 was not just that the large technology stocks, popularly referred to as the Magnificent Seven, did well, but there's a broadening of participation of the gains in U.S. stock markets. That extended to value stocks, some of the sectors like financials, industrials, and it also extended to smaller companies or small cap stocks, which also had very strong gains. And when we look under the hood, despite all the headlines that may suggest otherwise, from tariff uncertainty to a long government shutdown, actually the longest in history, to various geopolitical tensions around the world, the stock market just looked through a lot of those concerns and continued to ascend to new highs, closing the year at or near record highs. And when we really look under the hood, what drove that was continued strength in corporate earnings. So businesses continued to adapt to the dynamic economic environment and to produce strong profits, and those strong profits translated to strong gains in U.S. stock markets last year.
Those are great perspectives, Pete. U.S. markets have been the leader. Could you talk about international equity markets in 2025?
Absolutely. For most of the past 15 years, the story has been a consistent one of U.S. stock market exceptionalism and pretty much all international markets lagging relative to the U.S. Well, that script flipped in a material way last year, where we saw international markets, both developed and developing market indices, posting north of 30% returns, nearly double U.S. stock market returns. So it was a really strong year for international markets and extended this theme of a broadening of participation in stock market performance, which is a positive signal and sign. One of the other notable developments about international markets is that the U.S. dollar weakened materially last year by about 10% against a basket of other major currencies. And that helps returns for U.S. investors who are investing in overseas markets. That further benefited those gains in markets. So great year for international stock markets last year.
That's a great recap of the equity markets. How did fixed income perform?
Sounds like a broken record, but fixed income markets also had a great year. So it was a broad-based, strong year for financial markets. Now, bond markets didn't post the type of double-digit gains that we saw in stock markets around the world, but really did have another great year with the benchmark Bloomberg Aggregate Bond Index up about 7% on the year. That's a great year for bond markets, and that was driven by strong yield or interest payments, given yields have increased over recent years. But we also saw interest rates begin to decline. And when interest rates decline, what that does is it raises bond prices, and we saw that happening across fixed income markets last year. And what also helped with the interest rate decline is the Federal Reserve began reducing interest rates again. So that was really the catalyst for the interest rates to decline, and we saw that really accelerate into the end of last year. So across the board, a great year for financial markets.
Pete, thank you for that recap of 2025. I'd like to pivot to 2026. Do you think the U.S. economy will remain resilient despite some of these geopolitical challenges and some of these headline risks?
Great question, Brian, and that really is the fundamental question. The big theme of the U.S. economy for the last handful of years has been resilience. There have been myriad calls for recession from all sorts of economists and for all sorts of reasons. In 2022, it was the inflation and interest rate shock that everybody thought was going to derail the economy and lead us to recession that just never materialized. Last year, it was concerns about tariffs, the shock of Liberation Day, the government shutdown, elevated geopolitical uncertainty. All of these factors had led to concerns about the U.S. economy was finally due to have a recession, and it just hasn't transpired yet. And we've seen continued strength. And as we look forward to 2026, that momentum is in place and is likely to continue. When we look at some of the positive factors for economic growth next year, one of the notable ones is stimulus from the One Big Beautiful Bill Act that was passed last year is mostly going to start benefiting the economy this year. There was very little benefit from it last year. So that should be a positive impact to growth and to help accelerate it. The second big theme that really drove a lot of the growth last year and that we expect to continue is this investment boom from the artificial intelligence build out and the infrastructure to support it. And that is expected to continue and accelerate in 2026. So another positive factor for growth. So when we look at momentum from last year leading into this year and some of these additional factors, the most likely path is for continued resilience of the U.S. economy. That said, there are risk factors out there that we're monitoring, and the most notable one revolves around the U.S. consumer. As we've spoken about in the past, consumption represents about 70% of economic activity in the U.S., so it is the most important factor. And when we look at U.S. consumers, in aggregate and on average, they have been resilient. But what we've seen really happen in the last year or two is this, what's being referred to K-shaped economy emerging, where we have the wealthier cohort within the U.S. population is doing exceptionally well because incomes have grown, but more importantly, asset prices, like I talked about earlier, have really grown a lot in recent years, so wealth has grown, which has led to consumption. On the flip side, in the middle and lower end of the consumer, what we've seen is a much more difficult environment. We've seen income stagnate relative inflation. There's a lot less exposure to financial markets, so their asset price growth hasn't been the same, and the wealth effect hasn't been the same. So we've seen a lot more stagnation and weakness in that middle and lower end consumer, and at some point that's got to normalize, you would think, and the question is when. And you can see it in a lot of sentiment surveys. Consumer sentiment has been very, very low, almost at recessionary levels on average across the economy, despite continued growth. And that's really a reflection of what we're seeing in this K-shaped economy. So not necessarily a point that recession is imminent, but it's something to watch as how long is this trend sustainable and when does it potentially normalize and how.
Pete, thanks for that outlook for 2026. Are there any items investors should be monitoring during the upcoming year?
Yeah, there's a lot investors should be mindful of, and there's a lot to still unfold. But for us, there's really three primary things that we're focused on that we think are going to be consequential for the economy and markets this year. The first is interest rates. I spoke earlier about the decline in interest rates and how that really benefited fixed income markets and also more broadly financial markets last year. And while the trend is likely to maintain lower for interest rates going forward, there's a lot less certainty around that path today than there was a year ago. And when we saw the Federal Reserve last meet in December, there was a lot of divergence in opinion around the future direction of rates and even that decision to cut rates. And on top of that, we got Fed Chair Powell's term ending in May, and President Trump will be appointing a new Fed chair, an additional source of uncertainty. So something we're watching closely is not only the direction of interest rates, but the level of volatility around interest rates. That can really have an impact on financial markets, fixed income markets in particular, and we believe it's going to be consequential in 2026. The second factor that we're going to be watching closely is this continued rise in U.S. government deficits and debt levels. We've been talking about this for several years. It's been on the radar for over a decade at this point because the trend continues to accelerate. But there were a few notable developments in financial markets last year that suggested maybe this is becoming more front of mind than back of mind issue for investors and markets. The 2 points that really drove that home were first was the price of gold rose over 60% last year, its best performance since 1979. That was a notable development. Gold typically does best in periods of global economic and U.S. economic weakness, and it also does well when there's concerns around the U.S. dollar and stability in the value of the dollar. And we saw gold have an exceptional year, and we also saw the U.S. dollar have a very challenging year where it declined about 10% against a basket of major international currencies. So that combination of factors suggests that maybe the risk of rising government debt and deficits is becoming a more present one for financial markets, which has the potential to create volatility. So we'll be watching that closely. The third factor that we'll be monitoring is the level of valuations in markets. We've been speaking about for several years that U.S. equity markets in particular are historically overvalued relative to history. And while that doesn't necessarily mean that they're due to decline imminently, it does suggest that there's not a lot of margin of safety baked into markets if things go wrong, if the economy weakens, if unexpected risks transpire. So we'll be keeping an eye on that closely. We saw some benefit from diversifying last year as other markets I spoke about earlier had stronger performance than US markets, but valuation levels will likely be consequential if and when some of these risks materialize.
Pete, thank you for those perspectives. Is there anything you'd like to leave investors with on how to navigate the current market environment?
Yeah, the most important thing is to maintain a long-term view and perspective and not to get caught up by the media news and noise. So the first thing really is don't try to time markets and stay disciplined to your long-term plan. 2025 was another great example of this. If we go back to a year ago and we look at the storyline was President Trump was getting inaugurated with an America First agenda. He was going to levy tariffs that were going to be very damaging to international markets and potentially the US economy. Recession risk was elevated. You would have thought that it would have been a pretty tough year for financial markets. Well, that didn't transpire. In fact, really the opposite transpired. It was a great year for financial markets, and the international markets were the star performers within those markets. So again, don't try to time markets based on the current news cycle and headlines, and don't overreact to short-term news events. That has consistently been a detriment to long-term investors through history. The second point I would leave you with is the power of diversification. While it may be tempting to invest in just a S&P 500 index because it's done so well for so long, that index has become increasingly concentrated in a small number of large technology stocks. And so the level of diversification is lower than it's been. It doesn't mean those are bad companies. It just means that you have an abundance of your exposure in a small number of stocks. And if something goes wrong, then you don't have as much risk management in your portfolio as you could. So diversifying to other markets, to other asset classes is a great way to manage risk. Diversification benefited portfolios last year as S&P and other US markets were underperformers. So maintaining diversification is really important. And then the third and final point, and likely the most important, is stay engaged with your financial advisor. Make your plan a living plan.
Pete, thank you for those insights. Thank you for joining us. We hope you have a happy and healthy 2026. We look forward to updating you on financial markets and economic trends at the end of the first quarter.
Thank you.